Hello and welcome to Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. Weak global cues drag the Lal Street lower. The Sensex slips over 400 points and Nifty loses nearly 130 points. The rupee loses nearly 40 paise against the dollar. Chaos across cryptocurrencies after the largest exchange, Binance, abandons its proposed deal to rescue its rival FTX. Binance cites due diligence and reports that FTX mishandled customer funds as the reasons. Cryptocurrencies lose $100 billion in value over the last 24 hours, with a Bitcoin hitting a two-year low. The union government is concerned about the private investment cycle not taking off. Sources say ministries have been told to consult with industry and find out the reasons. The government also mulls further tax breaks for select sectors. That's an exclusive. The ballooning fertilizer subsidy bill could disrupt the fiscal glide path. Government could shell out up to 2.5 lakh crore rupees as subsidy this year. Officials are pinning their hopes on global headwinds to mellow by next year. Supreme Court extends the status quo on commercial cultivation of genetically modified mustard seeds to the 17th of November. The government argues that opposition to GM seeds is based on unfounded fears, and regulators in US, Canada and Australia have reported no adverse impact. Clouds over the potential relaunch of Jet Airways. Sources say the Jalan Kolrock consortium is yet to fulfill its payment obligations. The consortium has also not deposited any of the 900 crore rupees it had committed towards capex and working capital requirements. That's another CNBC-TV18 exclusive. Uttarakhand health regulator directs Patanjali to stop making 5 so-called medicines and stop misleading ads with immediate effect. Warns that its manufacturing license could be revoked in the future. US government officials tell CNBC-TV18 that India remains their #1 priority on visa renewal. Says the waiting period for B1 and B2 visa interview waiver cases has come down to 9 months. Adds that a record 82,000 student visas were issued to Indians this year so far. Well, let's start with the market action. The benchmark indices slipped 1% each amidst weak global cues. The market is also awaiting US inflation data. The Sensex fell over 400 points today. The Nifty fell over 100 points. It managed to stay above 18,000. Banks and mid-cap stocks also closing in the red today. So across the board, selling pressure being seen today. Nervousness persisted in the global currency market as well. The Indian rupee has weakened on the back of a strong US dollar. $1 now costs nearly 82 rupees. Other Asian currencies were also trading lower against the dollar today. And speaking of nervousness, it's been an absolute roil across cryptocurrency markets, which are in turmoil. Binance, the world's largest crypto exchange, has abandoned a proposed deal to acquire FTX, which is another large exchange. Manisha Gupta is standing by with the chaos that we're seeing across cryptocurrencies. Manisha.
Well, it has been a disaster, yes. 48 hours after announcing that it is looking to acquire FTX, Binance has walked away from the deal. On the 8th of November, Binance had agreed to rescue FTX and signed a letter of intent pending due diligence. Today, citing due diligence, Binance has abandoned the deal. In its statement, Binance pointed to reports suggesting that customers' funds may have been mishandled. With FTX teetering on the brink, founder Sam Bankman-Friedman has lost nearly 94% of his personal wealth, making it the biggest wealth collapse for a billionaire in a single day. The collapse of the platform's token also impacted celebrities like supermodel Gisele Bündchen, American football star Tom Brady, and basketball player Steph Curry, all of whom have a substantial amount of their wealth tied with FTX. The FTX contagion has also spread to the rest of the market, with investors wary of a liquidity crunch. Global market capital of cryptocurrencies is now below $1 trillion mark. The last count was $850 billion there. The Bitcoin is trading at a 2-year lows, and that's exactly what you have seen with other cryptocurrencies, which have continued to trade below their crucial $20,000 mark, especially for Bitcoin and the other major coins seeing cuts of more than 50% from the start of this year. Whether it is about Ethereum, Cardano, Dogecoin, Solana, they're all down, and there is simply no place to hide. Solana probably is the worst affected over the last few days. It has fallen 45% in the last 24 hours after fears that FTX sister company Alameda, which holds the token, could sell its share. So chaos across cryptocurrencies.
It certainly is chaos across cryptos. Thanks very much, Manisha, for taking us through the details. Now, the Supreme Court has decided to extend the status quo on commercial cultivation of genetically modified mustard seeds till at least the 17th of November. The union government arguing that opposition to GM seeds is based on unfounded fears, and regulators in US, Canada and Australia have reported no adverse effects on health. The Genetic Engineering Appraisal Committee of the Environment Ministry has approved the commercial cultivation of GM mustard. Abhimanyu Sharma is standing by with the details. Abhimanyu, take us through the government's arguments in court.
The Supreme Court has extended its status quo order till the 17th of November on commercial cultivation of mustard. A batch of petitions have been filed before the top court challenging use of genetically modified mustard, claiming that there will be concerns not just to environment but also to human health. The union government, meanwhile, has been dismissive of these concerns and has claimed that these unfounded fears will hurt not just India's farmers but also the industry and the economy at large, since India imports 55 to 60% of its edible oil requirements, and use of genetically modified mustard is going to substantially increase the yield of mustard crops and will make India far more self-sufficient in production of edible oil. The union government has cited similar experiments which were carried out by various expert bodies in the past, and has also said that the regulatory authorities in various Western countries have already allowed use of genetically modified edible oil seeds. They have also pointed to the fact that India already imports canola oil and soybean oil, which has been derived from genetically modified seeds, and there is no reason why the same should not be extended to mustard in order to ensure that India becomes self-sufficient in the edible oil. It remains to be seen what further observations will be made by the top court in this regard and what contentions will be raised on the next date of hearing by the petitioners.
Abhimanyu, many thanks for joining us. Here's a CNBC-TV18 exclusive this afternoon. A fresh cloud over the relaunch of Jet Airways. Sources tell CNBC-TV18 that the Jalan Kalrock Consortium, which won the airline through the IBC process, has not yet fulfilled its various payment obligations, and the deadline to do so is just around the corner. Madhiya Mujawar joins us now with the details. Madhiya, what is the current state of affairs and what kind of deadlines are we talking about?
Well, there are two deadlines that the Jalan Kalrock Consortium has to meet, and as things stand, it looks to be in danger of missing both of these. Let's start with the closer one. The consortium has to pay 52 crore rupees to workmen and employees of the erstwhile airline by the end of business on the 11th of November. But sources tell me that this payment has not been made as yet. The second deadline you mentioned has to do with the payment of 185 crore rupees to various lenders. The consortium has time till the 16th of November to make this payment. And we learn that this has also not been made so far. As you may remember, the consortium had told the court that the effective date for its resolution plan would be the 20th of May 2022. And as per the resolution plan submitted, it had proposed to pay employees within 175 days and lenders within 180 days from the effective date. The problem, as I understand from sources, is that the Jalan Kalrock Consortium will get ownership of Jet Airways only after the first tranche of payments to the lenders is made. So if the consortium does not get transfer of the ownership, it cannot lease aircraft in the name of Jet Airways. Thus, any delays will mean that Jet's quick return to the Indian skies is in jeopardy. The relaunch target has already been extended by the consortium multiple times, with the last target of October also being overshot. But that's not the only cloud hanging over Jet Airways' relaunch. The recent NCLAT order directed the consortium to pay Provident Fund and gratuity dues in full for all eligible employees until the commencement of the insolvency, that is June 2019. Now, sources say this amount works out to over 200 crore rupees. I learned that the resolution professional has not yet given them the final amount payable, and so this has not been paid so far. Sources also say that the consortium has not deposited any of the 900 crore rupees it had committed towards capex and working capital requirement either. So in all, against the proposal and the commitments, the consortium has to pay close to 237 crore rupees, not including the statutory dues. So far, the consortium has not responded to CNBC-TV18's queries on this matter. But as things stand, if the two deadlines that I mentioned pass by without payments being made, Jet's takeoff in its new avatar looks quite uncertain.
Madhiha, many thanks for joining us. November 11th and November 16th, crucial dates for the Jalan Kalra Consortium to make those payments as per the resolution plan. That was approved. Madhiha, appreciate you joining us. A ballooning fertilizer subsidy bill may pose fresh fiscal challenges for the government. The union government is staring at a bill close to 2.5 lakh crore rupees this fiscal. That's almost 3 times higher than FY19. Sapna Das gets us the math on the fertilizer subsidy and what this will mean for the fisc. Sapna.
The fertilizer subsidy is a crucial part of the government's expenses every year, and the trend over the last few years has been a bit worrying for a government that is keen on sticking to a fiscal glide path. During the last 3 financial years alone, fertilizer subsidy has been clocking a new high every year. From a modest 73,000 crores in 2019, the number has nearly jumped 55% in 2 years to 1.33 lakh crores in 2021, and then to a record 1.62 lakh crores last fiscal. For FY23, this number is expected to come in anywhere between 2.25 to 2.5 lakh crores. This is based on the fact that the Department of Fertilizers has asked the Finance Ministry for an additional 1.48 lakh crores, which means that the budget will nearly double from its original size. Of this enhanced budget, 1.4 lakh crore is broadly earmarked for urea. That's 125% higher than the budget estimate. Nutrient-based subsidy is expected 112 crores, which is 166% higher than the original budget outlay. A 2.5 lakh crore fertilizer subsidy bill is huge for an economy of India's size. Even at an expanded nominal GDP of 237 lakh crores, this works out to 1% of the GDP. It's also a little higher than the food subsidy budget of 2 lakh crores for FY23 if the additional financial burden brought on by the government's free food and grains program, the PMGKY, is not counted. But the government is hopeful that the shock of a higher subsidy bill will not spill over into the next year. According to government officials, as the ripple effects of global lockdowns and the Russia-Ukraine conflict fade away, next year's fertilizer subsidy bill is likely to be lower, helped also by lower input costs and softening gas prices. In the meanwhile, the government is caught between a rock and a hard place because it remains committed to protecting farmers, and fertilizer subsidies are a crucial part of that. On the other hand, it also wants to maintain its fiscal glide path. The only silver lining is that when it comes to fiscal deficit, the government can deviate from its target if extraneous circumstances beyond its control continue to play out.
All right, Sapna, appreciate you joining us. So that is going to be a challenge for the government. Up next, the union government is concerned about the private investment cycle not taking off. We discuss that and more with former Finance Secretary Subhash Chandra Garg when we return. Well, it's time now for a CNBC-TV18 exclusive. The government is concerned about the private investment cycle not taking off just yet. Ministries have been asked to reach out to industry to find out why investments and capacity building are not taking place. That's not all. The centre is also mulling tax breaks for select sectors to try and drive private capex. Parikshit Tutta standing by with more in the CNBC-TV18 exclusive. Parikshit.
Well, the government has been concerned about the pace of private sector investment and why it's not really been taking off, barring a few sectors. Now, all ministries ahead of the budget have been asked to hold stakeholder consultations with different companies, with different industries, take feedback on why they're not making further investments, what will be needed in order to add additional capacity as well. Some feedback they have received is indicating about a global slowdown, and many companies, many sectors don't see a strong demand globally, because of which they're not making those big investments right now. Ministries have been asked to make suggestions on ease of doing business as well. There are certain tax breaks which are being considered for sectors in order to drive demand, domestic demand, allow companies to tap into domestic demand and also drive investment as well. PLI schemes, we believe that very high-level reviews of PLI schemes have been taking place. The government believes that many of these PLI schemes are still in very early stages, and it will take some time for those investments to actually be seen on the ground as well. Some of the sectors from whom feedback has been sought include steel, white goods, solar PV modules, cement, auto components, and all of them are being asked as to why the pace of investment has been slow so far and what can be done to speed up private investment.
We will do everything to get industry coming and investing here. Give PLI. We've given PLI. I want to hear from the Indian Inc. What's stopping you? When countries and industries abroad think this is the place to be in now, at this time. FDIs are coming, FPIs are coming. It's all, the stock market is so confident, the Indian retail investor believes in them. Is it like Hanuman? You don't believe in your own capacity, in your own strength. And has there got to be somebody, standing next and say, hey, you're Hanuman, do it.
Well, that is the finance minister there in September asking industry what was holding it back from making investments. Now, let's talk about PLI. The production-linked incentive schemes have not taken off across many sectors. Also, it is important to contextualize this. The PLI schemes have been staggered. Not all of them were notified on the same date. In a recent speech, the Chief Economic Advisor, Anantha Nageshwaran, was citing data from the DPIIT as of September this year. The data shows that pharmaceutical drug manufacturing has achieved 107% of the investment target that the government had envisaged. However, only 13% of the employment target has been realized so far. Remember, the PLI scheme for the pharmaceutical sector was first off the block in 2020. The other relative outperformers are also linked to pharma, with active pharma ingredients and medical devices faring better than some of the other sectors on both parameters. Mobile phone manufacturing has realized 38% of the investment target, but only 5% of the employment target. The food product sector, meanwhile, has achieved 54% of the investment target and 49% of the employment target. It must be noted that pharma PLI schemes, as I mentioned, were among the first off the block when they were launched in 2020. In sharp contrast, the electronic PLI was launched in April 2020, has achieved less than 5% of the stated investment target and less than 0.5% of its employment target. Of the PLI schemes launched in 2021, specialty steel, automobiles, drones and their components have not seen any investment so far. White goods PLI scheme has seen 13% of its investment goal being met and 16% of its employment target. However, two schemes launched in 2022 have already seen some traction. Solar panels have seen 27% investment and 8.5% of the employment target being achieved so far. Textile PLI has seen about 7% of its investment goal being met, though no employment under the scheme has been generated so far. Well, to talk about where we currently stand as far as private capex is concerned, and more importantly, whether additional tax breaks will really change the cycle around, we're now joined by Subhash Chandra Garg, the former Finance Secretary. Mr. Garg, appreciate you joining us here on CNBC-TV18. You know, that was the Finance Minister's message to industry in September. And for the benefit of our viewers, we've revisited the PLI data as was put out by the Chief Economic Advisor. And again, as I'm contextualizing, the notification dates, the rollout dates differ for different schemes. But what I want to understand from you, is it fair, given the fact that capacity utilization across sectors varies between 60 to 70%, so 30% continues to be idle, to expect industry to set up fresh capacity when they don't have demand visibility?
So the data which the Chief Economic Advisor put out actually gave you a very good state of the play as far as the PLI schemes are concerned. And the PLI schemes are basically for industrial investments. They are not for infrastructure, where much more investment flow is needed and is taking place through the government to some extent. So let's focus on the industrial investments through PLI or otherwise. And there, if you again go a little bit deeper into it, there are PLIs which are targeting essentially the digital innovations or investments, for example, on the semiconductors, and some parts which get into other goods like white goods and others, where electronic chips and others are making the difference. And the rest are more traditional industries like textiles and steel, and to some extent that kind. The data which is there is the data of the investments committed to the government and approved. It's not of the investment which has taken place and the disbursements which the government has made. From the disbursement point of view, if you look at it, only two disbursements to my mind has taken so far, and nothing seems to be very much in the horizon very soon. So the state of play in PLI, which is our cutting edge, which is our most crucial intervention in the investment side, is not very, very good. And that is what we should, it should make us sit up and take notice that why is it? And if you go into that, in my judgment, there are two problems. The problem number one is that we have PLI, which is very widely disbursed now. There are 13 sectors. If you add up products, there are more than 30, 40 products for which the PLI is being granted. It's becoming general. It's not focused. It was very well when it was focused on the mobile phones. It was also somewhat well when it was focused on, let us say, semiconductors, though there are different kind of problems on the semiconductors. But when it spreads to white goods, textiles and others, you lose the focus. That's one. Second, these are all in a way incentive driven, that the government will pay incentive if you produce that kind of investment in exports. And these are no different from the earlier kind of investments which the states were giving through the investment promotion schemes and all. And therefore, there is enormous amount of bureaucratic problems in implementation of this. And that gives me some doubts that the PLI actually will not achieve if you have so much thinly spread and so many PLIs.
Okay, so you're saying that widening the PLI ambit is not necessarily the best way forward. In fact, we're given to understand that at this point in time, the government is considering bringing more sectors under the PLI scheme. In fact, a separate or a second PLI scheme for vaccine manufacturing specifically, and raw materials linked to vaccine manufacturing being considered at this point in time. But Mr. Garg, you know, and I'm looking at the CMI data that's come in. It says new investment proposals to create fresh productive capacities in the private sector seem to have recovered. Preliminary data from CMI's CapEx database shows that investments proposals worth 3.1 trillion rupees were made by the private sector during the quarter ended September 2022. This is higher than the new investments proposed by the private sector in the past. So, you know, is it a matter of time? Because again, as I pointed out, several of these schemes were notified. The execution is just about starting. That we will see a pickup. Are we on the cusp of a recovery, you think?
See, if you, our capital investment per year is about 55 to 60 lakh crores. The government makes about 7 lakh crores to 7.5 lakh crores of the capital investment. In this context, a 3 trillion rupees commitment is really small. It looks like better than the previous quarters or something. But if you look at the overall kind of investment which needs to take place and which takes place, this is very small. So it doesn't give me that sense that if there is a small pickup, and again, some of these investment intentions don't really translate into actions, like what happens in most of these states in these investment kind of summits. A lot of froth is there in the MOUs which are signed and all. The translation rate is very small at 10 to 15% or even less in some cases. So I don't think you should read this CMI pickup as a sign or as a confirmation of a massive upturn or turnaround in the investment cycle.
Yeah, it is with that caveat that these are investment proposals that we are speaking of. But Mr. Garg, you know, we're a couple of months away from the budget consultation process is underway. As Parikshit was telling us just a short while ago, ministries have been asked to reach out to industry to try and find out what's holding investment back. Do you think any tax intervention at this point in time is warranted? Will that really move the needle? Because it comes back again to the point that I made, that if you don't have demand visibility, no matter what tax break you get, will you actually add fresh capacity?
Absolutely. So the businessman will make investment only if the businessman sees a profit at the end, and the profit comes only if there is a demand. You don't make investment for the sake of for its own sake without actually visibility of profit being there. And the government had done, has taken lots of steps to that. The biggest one was the manufacturing companies being subjected to a very low tax of 15%. What better tax incentive can be there if you believe that the tax can or tax incentives can incentivize investments? And that manufacturing company taxation at this rate has actually not taken off. What else you can give, and why, unless, as you all and me were saying, unless there is a demand pickup. And if you analyze from that point of view, the traditional industrial production is actually, the capacity utilization is much less. It's about 70 to 73%. There, much of the demand can come from export, but there we have some of the policy problems, which we just look at the steel industry for that matter. When the steel industry had started producing for the world, we put export taxes. And that has killed the exports demand in the steel industry. Likewise, if you look at the renewable sector, we have a lack of clarity. What do we want? We want make in India of the modules and cells, or we want higher investment in the electricity sector. And when we put up the anti-dumping duties and other kind of extra duties for the import of cells, we may make the domestic investment in cells and modules somewhat better, but it may not be enough, and that's why the investment is not taking place. But we also kill in the process the investment in the renewables. And that confusion in the policy, I am tempted to say that the finance ministry invites people to act like Hanuman. She's appealing to the reptilian tendency of the businessman, the animal spirits. But the business is not animal spirits. Business is a lot of cool-headed calculations. And unless that calculations tell you that they profit at the end of it, the animal spirits don't count. I don't think that works.
Yes, well, at this point in time, across surveys, industry is still talking about wanting to wait for another 6 months at least to be able to get a firm grip on what the domestic demand situation looks like, and more importantly, the fragile global recovery that we were seeing, which is, of course, also faltered on account of the many developments that we've seen globally, inflation rising, and, of course, interest rates as well.
We had the opportunity. There was a China Plus, which provided us opportunity. There was a bump up in the global demand post-COVID. And that opportunity we have, in fact, allowed to slip by. The Vietnams of the world have taken that much more. And today, Vietnam produces a lot of industrial goods, much more than what the India does. Electronics. Vietnam production is about 10 times of what we produce. And instead of looking for next, which is perhaps a period where there is a global recession and the demand side would be much lower globally as well as domestically, I think we should think about why we have allowed this opportunity to go by.
Mr. Garg, always a pleasure. Appreciate you joining us here on CNBC-TV18. That's it then on this edition of Business 360. We're going to take a break and return with a lot more news. Don't go anywhere. We're back in a minute.